This is Nidhi Sancheti. What an honor to address such an august gathering. For today's insightful sessions, we have two very special and intelligent minds with us. And I would like to welcome on stage Mr. Vansh Oberoi and Ms. Siddhi Dalmia. Can we have a huge round of applause? Mr. Vansh Oberoi is the managing partner of VC Grid. He is an operator turned venture capital professional with over a decade of experience. He has executed 150 plus transactions on the Venture Catalyst Angel platform in his capacity as the Chief Investments Officer. Welcome, Vansh. Ms. Siddhi Dalmia is a seasoned venture capital professional with over 12 years of global experience. She began her career with Goldman Sachs Investment Banking Division and has since worked in multiple geographies across a wide range of sectors such as financial institutions, technology, retail, FMCG, infrastructure, and distressed assets. In 2023, Siddhi co-founded VC Grid under the Venture Catalyst Group. Thank you so much for being with us, and over to you guys.
Thank you so much everyone for being here. And thank you Young Leaders Forum
core committee for actually inviting us here. Vansh and I represent VC Grid. VC Grid is essentially a community of family offices and ultra HNIs, and we help them make startup investments. We are part of a larger entity called Venture Catalyst Plus Plus, which is a Mumbai-based entity. It's a multi-stage VC fund. In addition to running a very successful core syndication business, we also manage close to $400 million in AUM across 4 VC funds. So that's where we are. We've been made to understand from Anudeep and the core committee of YLF that today the audience mix is like 3 people. One is who have already started startup investing, who are already looking out for opportunities, the next unicorn probably. There's few people in the audience who are probably on the fence, dabbling with smaller amounts, and maybe a bunch of you who are just out of it right now, thinking of it like a black box. Maybe this is for me, maybe this is not for me. So Vansh and I are here to maybe address all of you, cut the noise, share your insights, and most likely, we on the journey, we would like to spark some curiosity. So here we are, we would just want to decode this for you. So strap in, this is how we would like to use our next 60 minutes, wherein, in the next 60 minutes, we would like to understand, is startup investing really new, or is this something which is being age old? How does the Indian startup ecosystem look like now, and what can we expect 10 years from now? Are we really scratching the surface, or are we done? Is startup investing relevant for you? Every asset class needs an investor. Whether this one adheres to you or not, let's find out. Taking the startup investing journey, what exactly can you entail while you are making startup investments, and how can you make better and more prudent decisions? Selecting the right co-pilots in the journey, it's very important to have the relevant team, to have the relevant professionals guiding you. So how do you really select them? The investment life cycle, behind the scenes, what is the chaos, what is it that we look for? So that is what we are going to cover here. How to evaluate and build thesis. Okay, I want to start investing, but how do I really build thesis? Let's spend some time here. We'll also talk about how do we get our money back, because investing is easy, but getting back money is important and crucial. So that is how exits would work. Vansh and I would love to share our successes and failures individually. We hold close to 15 plus years of experience into this. We have a lot of success stories and many more failure stories and learnings. So would love to share all of that. And then some important tips that we can share to sort of help you navigate this asset class. Are we really new to investing, or not really? It's a century age-old process. Remember Christopher Columbus? He started with a very radical idea. He wanted to sail west to discover Asia. He pitched that idea to a lot of royal courts at that point in time, because when he was on his path, it wasn't the preferred or the known trade routes. He got rejected by many royal courts, and then finally Queen Isabella and King Ferdinand invested in him, equipped him with crews and ships, etc. And that is how he went on his journey. So he had an idea. He was backed by the kings and the queens of that time, and it was a risky idea. The outcome not known, but it was very disruptive at that point in time. Well, where did he end up? He definitely did not come to Asia, but he did discover Americas, which changed the global trade forever as we are looking right now. So that is what we are talking about. Key ingredients of investing in a startup hasn't changed. We knowingly, unknowingly have been backing companies, being part of disruptive and radical ideas for the longest of time. So the key ingredients are this. There has to be a mission and a vision, and why we are really sailing out for that expedition. It was definitely the highest risk at that point in time. The team and the leadership, the people who really believed in Columbus, the team who actually put together the ship and the crew together, what was the defensibility and the moat in his idea, and finally the kind of impact that he was able to do what he set out to. So that is really startup investing. It's no rocket science. It's as simple and vanilla as it can be. धंधा हमने बहुत टाइम से किया है, अभी नेक्स्ट जनरेशन ऑफ धंधे को सपोर्ट करना है. It's as simple as it can be. This is where we're talking about Indian startup ecosystem.
Good evening, everyone. I just sort of like to highlight. I think the entire as Siddhi highlighted, the principles of investing is something that we've been doing since a lot of time, but over the last 5 years, this buzzword of startups, and I think ever since Shark Tank came to India, it just brought startup investing into our dining room conversations. But what has sort of given the whole momentum, so I'll just sort of highlight the key events which all of us have sort of seen around us. I think from 15 to 25, a lot of very interesting events happened in the country. I think 2016, when Jio revolutionized the whole internet, everybody got internet on their palms. Today, India has about 900 million internet users. That's 2/3 of the Indian population equipped with internet thanks to Jio. 2016, the whole demonetization happened. Because of that, the entire tech infrastructure, specifically on the payments, UPIs, got developed. Today, even a US economy doesn't have a UPI stack, which India very proudly has and is starting to outsource it to other economies. Then we had this famous news of Walmart acquiring Flipkart and bringing those many $1 billion in the Indian economy, which really started everybody to look at this asset class very seriously. 2020 COVID happened. Now when COVID happened, whatever infrastructurally we were ready with internet, we were ready to make payments online. But 2020 forced everyone to start using those technologies, start leveraging on that infra. People who are averse to UPIs started transacting. People who are still relying on unorganized players for making phone calls, etc., doing a lot of contactful stuff, moved to online. We all saw rise of Swiggy, Zomatos, Olas, and Ubers. So I think 2020 is what accelerated the whole tech adoption. You saw boost in e-commerce, you saw boost in Nykas of the world, Amazons of the world, fintech sector boomed, health tech sector boomed. Tech IPOs took off. 20, 21, 22 were the years where a lot of tech companies like in US started listing themselves in India. And then 23 also happened where everything pretty much got corrected again. And the market really came out of a cycle of a lot of emotional investing and towards maturing. So I think in the last 10 years, this asset class has really tested the time, seen the rise, seen the lows, and one thing that it has really established it, that it's an asset class here to stay. Why now the startup investing is gaining momentum? As individuals, I think all of these attributes are something that you all can see around you. Wealth expansion, statistically speaking, India has seen 6 times more growth in individuals earning 100 crores or more per annum, and it's a number that has reached almost 3,400. Today you have almost 60,000 individuals, and all of these are reported numbers, so we all can imagine what's the unreported market looking like. But 60,000 people today earn more than 5 crores in the country. almost 31,000 people are earning more than 10 crores per annum. So when that wealth expansion starts to happen, automatically people start looking at diversifying. Your first set of investments would go towards real estate, then to gold, then to public markets. And as the wealth pool of the economy starts expanding, the alternative asset class automatically picks up. It's now becoming a preferred asset class for diversification. Angel investing, and we'll cover into angel investing as we progress, but within the angel investing ecosystem, which is fairly new, I think post 2020, angel funds is a semi-regulated product that enables HNIs to make smaller investments into startups. That industry in the last 5 years has invested $500 million, so almost 5,000 crores in startups. Churning of capital and exits, right from institutions at the top who are exiting from IPOs of companies like Nyka's, Zomato's of the world, to seeing a lot of mergers, acquisitions at 200, 300, 400 crore valuations happening. This ecosystem in the last 5-7 years has also seen exits, which is what has given confidence to people, which has spreaded that word of mouth when people hear people exiting an investment, making some returns. That's the best kind of marketing that has happened to this ecosystem. In fact, as per CRISIL, and if you track the US stats and the India statistics also, people who have been investing in funds, the returns have been 5% better than people investing in mutual funds and those listed index funds. So statistically, all figures, but obviously you also expect if you're investing in this asset class, you do look for a 5 to 10% better return as compared to other asset classes. And also, I think especially after 2023, when a lot of corrections in the market and the famous funding winter happened, the formalization of this economy has also played a huge role in streamlining and giving more confidence. Semi-regulated products have actually become the forefront of leading this asset class nowadays, which prior to 2020 was not really the case. Prior to 2020, very few players in the ecosystem were regulated. Today, almost all players in this asset class are regulated by regulators, which brings in more trust, more confidence.
So, what really makes it a fit, and is it really for us? Is it for each one of you? Everyone, I believe, whoever is planning in this room to make an investment should make their own independent decisions. Is it for me? A few reasons which works in my favor is this asset class certainly has the potential to give disproportionate returns. So people invest in this asset class in spite of knowing that it's the most illiquid asset class out there. It probably is the most riskiest. But why do I then even need to diversify more? Especially when the public market vintage in the last year was really good. But this is the only asset class probably has the potential to give you outsized returns and disproportionate returns. It's a very well-known portfolio diversification strategy. You balance this out with your core investment into public estates / real estate, gold, and any other liquidity instrument. So it gives you an overall balance when you're allocating wealth. It gives you early access to innovation. Imagine getting an early access into disruptive technologies, being a front runner rather than when they're listed, when they're already grown and probably overvalued. So that's where startups would actually make a difference when you're planning your investments. The legacy and the strategic value. We work with a lot of family offices, we work with a lot of second generation, third generation, and people want to own a page of their legacy. So this is your time to rewrite your legacy in the overall scheme of things in your family businesses, wherein you co-invest, you know, co-found maybe a startup, nurture it like a baby and call it your own. So that's the freshness of this asset class. The co-investment and the P2P networking, I cannot emphasize this point more, wherein a lot of learning from like-minded people, investors, and from the ecosystem actually happens when you are investing in this asset class. A lot of influence and engagement beyond, numbers. So we are talking about strategic inputs and networks that you actually find yourself in when you're investing in an asset class such as this. Imagine early access to future winners, absolutely. Imagine getting a bite of a Zomato or a Nykaa or a First Cry or a Paytm early on in their journey when they were seed stage startups raising money at single digit, double digit crore valuation. So that is what we're talking about. Of course, all of us are on a hunt and a chase to find the next unicorn, but that's where you start. You start building your portfolio early with disruptive technologies and companies and higher business safeguarding. Now, this is also a point which has actually come in a lot of our conversations with business owners and family businesses, wherein they themselves might be mammoth and veterans in their own industry, but you never know a 20-year-old in Ambala may just disrupt your entire business with something innovative. So people are actually using this asset class to keep their eyes and ears closer to the ground to understand, okay, what's the next disruption that's going to happen in my own business. And that is why it's very crucial to keep yourself open to this ecosystem. We will talk about how startups as an asset class is of course financially lucrative for me, but what is it doing for the nation? They are actually the nation builders, if I may talk about. If we were to live a $7 trillion economy by 2030, 1 trillion is going to come from this asset class. Job creation and ecosystem growth, this asset class is adding a lot of jobs like never before. Innovation and tech advancement, a lot of innovation, disruption across sectors, be it finance, be it defense, be it consumer. A lot of new age brands or new age technologies are coming to disrupt older businesses. It's of course attracting capital. It may look like an alternative investment class, but it's a mammoth of an industry wherein a lot of fund managers globally, domestically are looking at it very closely. Global reach and exports. As fund managers, we are always on the lookout for those businesses who can actually sit in a corner of the world and sell globally. So we're looking for cross-border businesses. Who's the person who's going to add value across? So this asset class actually has a potential to do global reach and exports. Tax policy and impact, absolutely. Most of our people in government would have seen talking about startup policies, talking about ease of doing business, and that this is what it gets to us. And financial inclusion. The way we now transact as Indians, it has never been easier. With things like Paytm and QR codes and everything across. So there is disruption in every field. How we order food, how we pay for food, how we discover food, and every segment of our life. So that's where startups play a role even beyond financials and investments.
I think now, if you sort of, so far if you've gotten this to this level where you understand that some of these things are important and you do want to start, now how do we start this journey? So now take a couple of slides to just decode what are the ways to start investing if you haven't invested, and if you can just have a show of hands to understand if how many people have actually invested in a startup from this audience? Okay. And how many have maybe invested in a fund which is investing in startups or VC funds? Okay, I do see a few people. So yeah, I think I'm the great audience. Please feel free to challenge us on or ask us any of these questions. But yeah, I think for a lot of people who are starting, I'll just give you a different perspective. I think you can start investing in start two broad ways. First is that you can build your own portfolio. Like you do it, like if you all are using Zerodha's, you select what stocks, whether a mid-cap stock or a small-cap stock or a large-cap company's equity you want to buy. So that's like building your own portfolio. Or you could do it the mutual fund way, which is buying into a portfolio. When you buy into a portfolio, that's like investing in a VC fund. Broadly speaking, you have fund managers who have different track records, different theses. You will meet these fund managers, they'll pitch you their thesis on what will they be investing in, how will they make you money. You can commit some capital to those funds and those funds will make you. All of these funds are semi-regulated. The minimum corpus to commit to any of these funds as per SEBI is 1 crore. Though typically, like once the funds start becoming more and more successful, they start creating a higher entry barrier. because it's a function of if a fund manager needs the money, the demand for being part of the fund is so high, and that's it. And SEBI has also capped the number of people that can be part of a fund. Because all of these are private entities, even the fund and even the investments that will happen through the fund. So, for those reasons, beyond a point of time, entering in VC funds also becomes difficult. But I think you will in the country today be able to get into 90% of the funds with a 1 crore minimum check, and the fund manager will make your own portfolio. It is similar to buying units of a mutual fund. You will never be getting equities directly into the startups that the fund is investing, but you will get unit statements pretty much like a mutual fund statement scheme. It is managed end to end by the fund manager. It is a passive way of investing. You can decide the fund manager you want to back. Beyond that, you cannot stop him from investing where he feels he can multiply your capital. There are three categories of funds: 1, 2, and 3. That's what you would have heard. Coming to the other side of the table, wherein you make your own portfolio. Now, again, there are further ways of making your own portfolios. One is that you take direct equities in startups. That particular case, let's say, an example is from Calcutta, and one of the biggest success stories from Calcutta in our world is Wow Momos. So, some of the people at the previous organization that I was part of, we were investors in Wow Momos. So, a lot of our investors, whoever invested through us in Wow Momos, had shares of Wow Momos directly. From the current organization, we backed another success story from Kolkata called Rare Planet. So, if you're investing directly in these companies and taking equities, that's like building your direct startup equity portfolio. You're buying shares of the company. Nowadays, what has really happened is founders who have seen some success or who feel that they are on a path of a successful journey of the venture, they automatically start increasing the ticket sizes at which we get access to invest in those companies. Now, again, why does this happen? This happens because beyond, if a company has more than 200 shareholders, the company becomes a public limited company. The compliances burdens and the reporting standards change massively. And all of this, of course, famously happened after the whole Sahara scam that happened. So since then, and that's the reason why startups have equities as their assets. And as per the Companies Act now, you can't have more than 200 investors. The moment you cross 200 investors, you become a public limited company. Whether you are listed or unlisted, that's a separate scenario. But that's the reason why getting direct equity in startups today, specifically in good companies, comes at a slightly higher ticket cost. Today, the startup world is actually expanded, and the entire global economy is one. A lot of institutional investors have started investing. So, what typically also happens is when individuals are investing on the cap table directly, let's say there are about 50 people owning 0.1% in a company, that may $2.5 of the company. But from an institutional investor who may want to come and acquire the company, he needs to get a buy-in from all those 50 people also. So I think as the ecosystem has matured, good founders today prefer the way of pooling capital. Pooling capital is also now semi-regulated. You have structures like angel funds. You can form structures like LLPs amongst friends, private limited companies amongst friends. Few family members can form a family trust. Pool in a capital, take a more aggregated position. As an example, 5 people pooling in 20 crores can negotiate a 1 crore seat on the cap table of a company, rather than 20 lakhs negotiate for 5 positions of the company. So that's a pooling for investing. You would have heard of angel networks like Venture Catalyst, Indian Angel Network, Hyderabad Angels, Calcutta Angels was one of the early angel platforms. So all of these angel networks used to enable pooling of capital as platforms, as profiles. We used to help our investors take an aggregated negotiated position in a company and do all the compliance work, diligence work, and expect our investors to just decide what companies they want shares in, and we will enable that. So that's the third way of entering into this asset class. Now, doubling down on you should be pooling in capital or whether you should be going solo. So it's purely a difference in if you have the power in numbers, wherein a group of people together can pool in a significant capital and make a difference, then pooling maybe is the right way and the better way. If you have something wherein you want to really control, stay involved, have a sizable position to take in the company, and want to really be involved from end to end, then taking that significant solo position is also a great way to do it. Pooling in capital, ideal for new investors, busy professionals who want to ride on the expectations or who want to basically ride on the judgment of people experienced in that asset class. So you can invest through angel funds, you can create syndicates, you can create SPVs. Benefits being it to diversify your portfolio. You could imagine putting a 1 crore of corpus as check sizes of 5 lakhs across 20 companies. Because those capital is sitting in a bigger round of 3-4 crores flowing in through a syndicate or that structure. You can enter with those lower minimum check sizes. Nowadays, all of these structures are also managed by semi-regulated AIF, so that gives you a grievance redressal platform in the form of SEBI. You get access to pre-vetted deals. You also get to access and invest in companies where you may not have a thesis in your life sciences company, for example. But in such platforms, you will often hear that someone who's an expert in that is leading that investment. So I think these are the characteristics of pooling in capital. Platforms like AngelList, Venture Catalyst, We Found a Circle, IPV, Indian Angel Network are all enablers to do this. Then comes taking direct equities in startups. It's nowadays more expected of seasoned investors to be doing that. Investors who have slightly higher ticket size and influence and can add value to the founders are the investors which founders also want to take on the capital. You get direct ownership in the company and much more visibility. You would save all that cost that you would be paying to the pooling entities or the pooling professionals. So that way your returns relative to the pooling capital would be better. You will have greater influence on business strategies and you will have involvement much more. It does require deeper due diligence, time and domain expertise, and it would come at a higher ticket and higher risk concentration. Examples of startups and a lot of people who've taken shares in these companies are like Septos or Rapidos or Vamos, Rare Planet are all. In fact, with Rare Planet, I know a couple of people in the room who invested with us in Rare Planet, and we've seen the company of us, he was highlighting. That company grew from pretty much less than $1 million valuation to today more than $25 million. More importantly, gave capital back 15 times in about 3.5 years to the early backers. So those sort of outcomes is what you will really look forward to, expecting from this ecosystem, and those are the broad structures in which you can really start. And depending on what's your appetite, what's your portfolio that you're planning to build, what's the expertise, these are the ways that you can really get into this ecosystem with.
So we'll probably take a pause here and just think back that if there is some curiosity at least generated in this asset class that okay, this looks interesting, let me sort of think about it. There are two ways to participate. One is of course you can go direct as Vansh said, and one is you use the help of a fund manager. If you want a more passive way, then of course a fund manager can take decisions for you. A more active style of investing is that hey, I want to get in, but I want to make my own charts. I want to control my own decisions. I want to select my next company I want to invest in. So that's where the next question is: how do I really find the right co-pilots or the right partners in this journey? There is one thing which someone told me that every Tendulkar needs a coach. So you may be on your A game, but be advised that you still need someone to guide you more holistically. So that's where we are. If we are actually looking for fund managers in this space, what are the things that we should actually look out for? So one key factor is how they are thinking about their entire deal thesis and the investment thesis. What is the value creation that they want to do by backing a certain set of sectors or startups, etc. So how they are thinking about making investments and what is their overall thesis, I think that makes a lot of difference. Their entire financial acumen when it comes to deciding valuation of the company, structuring that entire deal, stitching that deal together, how are they structuring, what are the different ways in which the founder can actually finance a cap table. Maybe equity is not for everyone, debt financing for profitable companies is good, it's healthy. So deciding on the right capital structure and then putting all the stakeholders on one table is very important. So the financial acumen of the fund manager really plays a big role. The operational expertise, because once we make an investment is made in euphoria. वो पैसे डाल रहे हैं मैं भी डाल देता हूँ. But पैसे वापस भी आने चाहिए with a multiplier. So how do we really ensure that? So once an investment is made, how do we assist and help the founder in actually growing the business? How can we help jointly to improve margins? How can we help this product scale globally? So a lot of operational work on the groundwork is actually needed with founders post investment as well. We're talking about risk management. So after the tariffs which was announced by the President of the United States, in a lot of our meetings we were questioned, ठीक है इस कैटेगरी में क्या इफेक्ट आया है, are they under this category? So we have to balance all those risks. There could be regulatory risks, there could be compliance risks, there could be operational market risks. So risks that are beyond also needs to be covered while we are evaluating a business model. And how do we really negotiate? There will always be tough situations when we are making an investment, when we are thinking about that, okay, I want to provide an exit, but the acquisition offer आया है. Now, what do we do about the acquisition? The company is growing pretty much well. Should we raise our next round? Grow the business? Should we accept the acquisition offer while it is on the table? So these are the tough decisions that the founder needs to take, and that's where the fund managers, the investors, everybody needs to get on the drawing board and cumulatively decide on all of this. So these are some of the things that we should look for in investment managers before even we select our right partners. The governance capability, given the fiascos specifically in the growth stage companies, how is the company reporting? Do they have the best governance practices or not? How are they exactly planning on their exit strategies? Because as an investor, and specifically if you're an early stage investor, you're always thinking about, okay, what could be the options in which I'll get an exit? Because at the end of the day, I am here to make money. So what are the likely options? Now, if an early stage founder raising 1 crore comes and says to you, okay, I'll do an IPO and give your money back, then okay, goodbye. So we should always talk about these tougher subjects that, okay, in 3 to 5 years timeline, what are the real or the most likely exit scenarios that I could get? The stakeholder management. So there are a lot of people involved while we are making these investments, and stakeholders in terms of governance, or stakeholders in terms of your legal and diligence players, fund managers like us, investors. So everybody needs to come on the same boat before we even make an investment. Just touching on due diligence, that before even we make an investment, because these are private investments, these are not as transparent as public market investments. So we go through a process of financial due diligence, legal due diligence, and business due diligence. So everything needs to make sense before we even put a single penny. And the value creation playbook. How do we really get this particular company that we are now set to back to value create in the longer term? So this is where we need to really think about that, okay, these are the kind of things that I really want to evaluate before I really start making investment and choosing the right partner. So if you've really thought about that, okay, I do want to make investments, let me decide on a fund manager, but still we would not advise you to go in completely unprepared. At least understand how this side of the world works, because being in Calcutta, and I am from Calcutta, so we know how the public market works really well. We know how the debt market works really well, but startups still a black box for many. So क्या होता है behind the scene and what really goes inside? So deal sourcing is, I would say, a key component in the entire startup curation, because that becomes your raw material, that becomes your product. So where are you sourcing your deals from? So our team, for example, there are many investors who refer us opportunities where they are getting invested in, and that's where we get more validated opportunities. The founders who we back, if we do right by them, they are actually referring us to more credible founders, and that becomes a very key, important sourcing channel for us. Most of the marquee startup events across the country, be it in tier 2, tier 3, tier 1, our team is present there curating opportunities. So it's a mix of everything. We get a lot of inbound interest from founders writing to us, but the team also decides on a thesis that okay, this looks good, and that's where I am also going to put in my proper research and reach out to founders in a specific domain where we feel that the market has tailwind. So those are the stories that go behind deal sourcing every single month. I believe we evaluate close to 350, 400 opportunities cumulatively and decide to back one or two of them. So that's the kind of filtration and decision making that goes behind the scenes. The next is the evaluation and thesis. What are the things we'll touch upon more on this, but how do I really evaluate and build my thesis? What are the sectors that I want to back? What are the stages that I want to back? What are the fundamentals I should look at while making an investment? So these are the things that we evaluate early on. The structuring and negotiation plays a very key role. Who are the co-investors? Are they likely to support, or is it gonna be a hostile, co-investment of sorts? So who are the partners who are coming along? A lot of our investment bets are actually, as fund managers, we also rely on the capabilities of other fund managers. Wherein, okay, this fund is participating and they come with a strong thesis and a strong portfolio, and that's where we should also co-invest. And it just sort of gives you a lot more confidence to write that check. So a lot of negotiation, and negotiation is not only on valuation, but it's also on the rights. It's also on coming two minds together with the founder, and okay, this is how we would want the company to function. These are the rights available to us as an investor. So that's where a lot of time also goes, and of course all this needs to be backed by proper due diligence on each aspect. So three fundamental aspects while investing in a startup is we need to get a very thorough legal diligence done. So it entails checking all the legal documents of the company, the land parcels, anything which can help us. Then we'll check their vouchers, etc. So anything that helps us getting a legal understanding of the business. There's a thorough financial due diligence done, looking deeper into their numbers, looking deeper into the claims of the founders, etc. And then of course we do a thorough business due diligence, whether or not the growth potential looks as promising as the founder has pitched to us, or what is the market size, or can we really grow, what is the execution capability, what are the partners. So all this probably sort of helps us make a decision before we invest. And of course, post investments is a different marathon altogether, wherein as fund managers we help monitor and track each of the investments, because making an investment of a couple of lakhs or a couple of crores might not be very meaningful for you in the overall scheme of things. So for the next 5 years, 3 years, 4 years down the line, how do I really get to know कि startup क्या कर रहा है, whether they are growing, not growing, whether they need intervention. So that's the kind of portfolio monitoring and tracking and reporting that we do. We enable business synergy. So as a group, we are invested in close to 350 odd startups. So we try and see, we try and explore synergies with our existing portfolio companies. We explore synergies with our investors. So if somebody comes from a technology background, and if I have a tech startup, how can I connect the two so that it helps the business? If somebody is in real estate and I have a prop tech startup, then how can I help connect that to the relevant investor? So there's a lot of business synergies that needs to be explored, a lot of operational support, strategic support. fundraising and financing, because once you invest in a company, we have to really ensure the only way you will make money and a multiplier on that company is that the company needs to do well. They need to provide an exit. They have to continuously build up round so that we as early stage investors get our exit. So our job as fund managers is really to help the company build their up round and to keep finding them new and more relevant investors. Exit and value creation, because that is where we really see the light of the money back. And then there's like never before an increased focus on governance and compliance. Given the fact that we are now a regulated sector, we are a much promoted sector, and if we talk about Indian parlance, we're just scratching the surface. So we really need to be focused on this. So this is behind the scenes how we do activities before making an investment, what are the activities, and then what we do post making the investment. I would love to spend some more time on how do we really evaluate a transaction. Okay, I do want to invest, but kya dekhna hai? What are the things I should be mindful of before even making an investment? The first thing which comes to my mind is the team, because we always bet on the jockey, not the horse. So, what is the credibility of the founder, the founding team? What is the execution capability? Has he founded businesses before and exited? What kind of educational background he comes from? If it's a first-time founder, how much conviction or the execution capability can I draw from? A lot of focus also goes that whether it's a solo founder or it's a jointly founded company, so that we hedge those risks. So team is of paramount importance when we are making investments, and more specifically in early stages, because a lot of it lies on the team and the integrity of the founder more than anything else. The second thing is the business proposition should be scalable. Giving you an example, I may be a fan or a user of a product or a service in Calcutta, we may love the service, but is it really an investable business or is it a lifestyle business at best? So many products, services, innovations that get pitched to us also are more like lifestyle businesses, wherein okay, they're making good business and profits out of it, but are they able to scale this at a national level without diluting their value proposition? Are they able to scale it internationally? So this is what we really need to see, that how scalable is the core business model, because investors can only make money when the business scales. There is absolutely no room for investors in a lifestyle business of sort. What is the real value proposition? What is the moat in the company? There has to be a differentiation. Why is the company, how's the company defensible? Is it some kind of tech innovation that the founder has done? Is it some kind of branding edge that the founder has? Is it some kind of scale that the company is already at? Or is it a sheer capital edge? Now, when we are evaluating companies which has a capital edge, you have to be mindful, because capital is now becoming a commodity. So what if his competitor raises a Y amount of capital and starts competing? So all these things need to be kept in mind when we are actually talking about value proposition. Then the proof of concept. How do we really validate this idea? How do we really validate the business model or the value proposition? The way we do it now internally is actually, we talk to a lot of business owners, much like yourself, we talk to a lot of investors, we talk to a lot of advisors and get their thoughts on any particular opportunity before even making an investment, so that it's sort of a business proof. They are the people who have been doing this for the longest of time, and that's where we would like to get a proof of concept from them. What is the monetization model? What are the various ways in which this business can make money? Is it being a B2B line of business or a B2C? Is it more subscription based business? Is it more products? Is it niche? Is it online, offline? So we really need to understand what are the different channels of revenue, and according to that we allocate resources to those channels of revenues. A channel of revenue which contributes say 5% to my top line, and if I'm investing 20% of my resources, then it's a mismatch. So these are the things that needs to be picked up when we are looking at monetization models. The market size. So this becomes really crucial when we are evaluating startups, because again, we see a lot of companies who have developed a niche, who have a very good product or a service, but probably the market itself is very small. It may be a very good business, but it's again, limits the scalability. So we really need to see the overall market size has to be big enough for a company to outperform and the growth potential of that company. Also, does the market have a room to have other challenger brands or companies? Is it a monopolistic market? We need to see कि market कितना बड़ा है before even investing in a company. Next is the exit strategy. We need to be very mindful of and very laser-sighted even before making an investment. That I have typically an investment horizon of say 3 to 5 years when I'm investing in this asset class. What are the likely scenarios of my exit? Typically an up round or a buyout or a mergers and acquisition, and finally an IPO. So what is the most likely exit strategy? And let's talk it out with the founder today itself, that these are the ways in which I exit the company. And then of course the defensibility and the more that I talk about what are the entry barriers. Again, we support a company, there's a good market, the founder is very good, but somebody else tomorrow can do it. Then there's no point investing in that business. A business has to be well fenced before we even invest in the company. Now that entry barrier could be technology, could be scale, could be brand, could be capital, but there has to be some defensibility mode in the business before we talk about it. Vansh, if you want to add something.
I'll just take it on from there. I think while all these things that Siddhi covered, when you will get evaluating to invest, I'm sure you will get a 10-12 pager investment note which will cover all of these things. But it becomes crucial to understand what is the weightage that you need to give to what attribute. And just when I decode that, I'll just break down the investments across 3 stages. One could be an early stage of investments, one could be an early growth stage, and the other could be growth stage. Let's define these stages in terms of business. You will be coming across terms like Series A, B, I. I'll cover all things. Yeah, I hope it works now. So I'll cover these 3 stages. Just try to link with whatever Siddhi covered on what attribute do you value at what stage. From defining these stages, let us keep our lens and focus towards analyzing these stages from the aspect of where is the business. If the business has discovered a minimum viable product or concept, but it has not started monetizing, it has not activated its revenue streams, those are typically the stages which we call as very early stage companies. You will hear about seed rounds happening at that stages, you will hear about pre-seed rounds happening at that stages. The people who will be investing at those stages would be some family offices, some angel networks, a founder who's exited a business and is giving back to the ecosystem from which he made money. What should be the focus? Now, coming to this stage of investing, I would advise you to judge instead of investing 80% on the profile of the founder or the team. Look at examples of Flipkarts and Amazons. They didn't start as Amazon and Flipkarts of today. They started something else, but it was those visionary founders who pivoted the business, who were not emotional about business and the idea with which they started, but they were open to being agile and pivoting through the whole journey and creating great legacies and businesses. The balance 15% of the attribute that I would suggest you to look at when you are evaluating a very early stage company is how big is the market size. Today, everybody is very keen to invest in defense tech, in aviation. Why? Because we all are expecting that the budgets in these particular areas and AI areas will keep on increasing. The market is going to expand so much that even an average company would grow with this in this way. When it comes to early growth stages, you'll have a lot of VCs, early stage funds investing in those stages. This is a typical stage where revenues have started to happen. When early stage revenues start to happen, that's the time You want to now start evaluating whether the product market fit has been achieved. What is the early traction looking like? What is the unit economics looking like? Will this business on scaling continue to grow? Then comes the growth stage. When it comes to growth stage, those are the times when you will have so much more things to look at. That is the stage when you want to look at what are the newer avenues of monetizing. Can this business continue to expand at the pace at which it has expanded for all these years? So, depending on the stage of the company, you need to really shift your focus to the attributes that you're looking at. I'll just sort of summarize the whole valuation this thing. I think this is one of the longest, and you can actually do a couple of other sessions on how startups are valued. In very simple words, when you're investing in early stages, valuation is an art and not a science. When you're investing in growth stage companies and you're trading public listed stocks, you have these multipliers, you have a lot of metrics to judge valuations. Typically, a company starts with 100% ownership, it ends with 100% ownership. The simplest way to value a company is to figure out at what stage can this company be self-sustaining, growing, and a listing company. And if at that stage, to get to that stage, it may take 7, 8, 10 years of journey. You will need to raise capital every 2 years to sustain the growth of the business. So at the end of the day, you want to leave enough equity with the founder who's driving the business for him to be incentivized and not become an employee in the company that he himself started. So I think in the early days, we start valuing companies from that backward method. Because if we have to put metrics of say a DCF, etc., DCF's assumption is to have 7 years of cash flows, which a new brand would never have. Exits very quickly, I would say you can pretty much expect an exit in 4 odd scenarios. One could be that the company is growing, more people are wanting to have stake in the brand, and that's where a secondary would happen. You may have an acquisition or a merger. You may, in very, very rare cases, see like with Oyo, Ritesh bought back a lot of his investors, and that was a company buyback that he did and gave exit to early backers, and then the IPO. So, I think just before I go to questions, just a couple of minutes on what have you learned from investing in startups, and what are some of the learnings that you can pick out from successes that we have seen. Clear market fit and deep consumer insight. Brands like Zerodha's, No Brokers of the world, or Universes are great examples. Zerodha became $1 billion brand without ever raising capital because they were solving a real pain problem and were extremely customer focused. Frugal, disciplined market growth. A lot of brands like again Zerodha's of the world and Universes were very, very frugal. They never overspent capital. Founders with grit and execution. See the journey of Sagar, of or Nykaa. The founders have been really focused on solving the particular problem that they wanted to solve and were successful. Timing, a lot of times the timing plays a very, very crucial role. A lot of EV companies which started early on in 15, 20 have really grown as the industry has evolved. A Razorpay, had they not switched to UPIs, supporting UPIs, the Razorpay wouldn't have passed the test of time. Culture, governance, trust, I think Zoho, Finance from India, great examples. Focused capital allocation, solving India first, Bharat scale problems. Because pretty much solving for tier 2, tier 3 also in India. These economies are much, much larger than many of the European countries put together. Funding support at the crucial time. And behind all of these names there are so many more interesting stories that I can keep on talking large, but there were also many failures that happened in this ecosystem. A lot of brands were chasing valuation and not creating real value. Companies like Housing.com, we saw them create all the noise but never really create value. Weak unit economics, bad timing. Pepper Tap, Dupalas, Lidos, you would have heard of these brands. The customer acquisition cost was so high and the lifetime value from a customer was never making sense. Founder investor misaligned. Go Mechanic, Dunzo, I think all of these brands people used and then saw them going out. Under governance, brands like Zelingo, BlueSmart recently got to all the unfortunate limelight because of corporate governance issues, lack of execution depth, funding crisis, inability to raise capital at the right time, regulatory disruptions. A lot of startups came in the whole crypto space. Even in our portfolio, we had invested in Coinex. We were having an exit offer at 13x to exit. We chose not to exit. 6 months out, the regulators stepped in. The business just died. We lost the chance to even exit. So I think those are also some of the learnings that come in. Tech disruptions. I think ChatGPT has disrupted so many tech businesses, and this ecosystem can never have immunity on that. So yeah, I think I will sort of pause here and would love to take questions if we have time.
When exits, so your entire money is gone, or there's some guarantee if I go through a fund house?
You are at the risk of losing the entire capital. But what typically, and honestly, I would say that also happens in 20-30% cases, that you try to salvage something out of it. If it is a tangible business, it's real assets, which I would say generally are consumer businesses, will still get a stressed acquisition offer coming out of it. Wherein you may get 40%, 30%, 20% of the capital back. In the last 2-3 years, we've seen multiple such transactions happening. We had a couple of consumer brands that got acquired by larger players, but when the brand was stressed, you are definitely at the risk of losing the entire capital that you have invested. What typically happens is the bigger investors in those transactions will always try to salvage something or the other out of it. The founder will try to get you some capital back. The fund manager will all try their best, but like today, the GoSmart example, we don't expect anything to be salvaged out. But I was pretty much very much involved in the whole transaction, but at some point of time there were offers where you could have salvaged something out of it. So you are pretty much at risk of losing everything if a startup goes out. Having said that, I would also want to add that exiting is a more difficult decision than entering into a startup. Because every time you are exiting and somebody else is buying you out, that someone is seeing 3-4 times more value in that brand. Even if you are sitting at 5 times capital at that point of time, you will always have that greed. If I wait more, I may get to 15 times along with this, and that's the greed that one has to also at that time. So I tip for a lot of early investors would be, do churn the cycle. Whenever you get the first exit opportunity, experience one exit cycle also. In some of the cases, I think a lot of people would advise you otherwise also that the longer you wait, the higher you will be. It frankly gets down to the function of with how much capital are you starting or what capital are you earmarking for this asset. I think a lot of those questions have to be answered keeping your own portfolio and risk profile in mind.
But 30% of the cases have been failures.
If you're entering in early stages, I'll say 50% of your portfolios will go south. They will never return you capital. You may expect 20-30% of your companies to return in your portfolio, but it will be those 5 to 10% which may give you those 20-30 times return, which is cover up for the entire portfolio. You will always see your failures surfacing first than your successful companies. A successful company will wait longer, maximize its valuation, then raise the next one. But the company which is struggling will be creating all the noise, will be desperately reaching out to all the existing investors asking for money to survive. So my advice to everyone would be that enter this asset class only if you are ready to make a portfolio consistently over a period of time. Invest across sectors, across ages, so that you play out on all different vintages. Like investments that typically in 2020, 21 are very overvalued. A lot of people invested at that time and then got out of the ecosystem in 23, 24 when the valuations were lowest in that asset class. So if you continue and do it consistently rather than emotionally, a very famous correlation I would do is the best way to make money in mutual fund is to do SIPs, not a lump sum investment. I think over the years and over the decades, people have experienced that, and that's how people now do it. And hence, with whatever strategy you do, you can still make a 10 to 15% IRR on mutual fund investing. In this ecosystem, that's where I think those learnings have pretty much surfaced in the last 2-3 years. You will not see money coming back in 30 to 40% of your portfolio company because every business will not succeed. Every business is likely to get disrupted, and therefore you need not panic, but consistently deploy money across at least 10 to 15 companies now. So that's our time, but we are around and we have to really customize the strategies that may suit you. Thank you for the patient.
Thank you so very much. We hope we could add some value and ask you to
Guys, can we have a huge round of applause for Siddhi and Vansh? The masterclass where we got a little bit intel into how to invest into startups. For a lot of y'all that already know that this is the YLF Business Conclave for the first time ever. And this is just day one. To kick off the things, we had this masterclass. We have a phenomenal next session to go. But I want to talk about day two before we move further. Day two is going to be all surprises. And there's a video to tell you more about it. Can we have the video, please?
आप फैसिनेटेड अभी फाउंडर बनता है या फाउंडर बन जाओ आपको भी कोई नॉलेज नहीं तू एज एंटरप्रेन्योर आया है या तू अपनी कंपनी बेचने आया है तू ये क्लियर कर ये सब ढोकला मैं तेरा ढोकला बनाऊंगा मुझे बातों में दिखने में मेरी कोई शौक नहीं है ऊपर से नहीं दिखना
Guys, wasn't that exciting? So, the whole idea was that on day one today, you all learned from BC Grid and the team on how you all can invest into startups. Going forward today, you will also learn from one of the best in the market on what you should do, what you should not do, and how you should be doing it. But the whole idea is that when you all go to day two, you all would have a good insight, you all will have a good idea of what to look at when you're investing in a startup, how to look at their valuations, how to look at their growth patterns, and learn how to be an investor.
Speaking of investments and startups, there's a lot coming ahead. And there's a twist to it. We have 6 different founders coming on the 29th that will pitch to us as a forum. We're all sharks there. We also have a panel of 6 supreme sharks, aside Ashni Grover, that will be there for the event. To wrap it all with a bow, there is more to it. Everyone has a space. Everyone has a group, only if you want to take it. Then we have another video to tell you more about it.
Guys, so what is a business conclave without knowing what your members do? The whole idea behind this is that even if you're not being able to pitch on stage, you should still have a space that you can take and you can pitch your products, your services, your projects in the second hall that we will be having that day, where you can book a booth space and display everything.
Different sizes, different games, different businesses. But it's all under YLF's roof. Reach out to any committee member today or the next couple of days to book your spot. And we'll see you all at day 2. Now, without further ado, we'll move on to the second and the most exciting segment of the evening. And to do that, we'll have Pratik Duggar on the stage, please.
Good evening, everyone. It's a pleasure to welcome you all today to today's forum. We are truly honored to have Mr. Siddharth Bhaiya, Founder, Managing Director and Chief Investment Officer of Equitas Investment Consultancy. With over 2 decades of experience in the Indian stock markets, Mr. Bhaiya has built a reputation as one of the most insightful and visionary minds in the world of investing. His journey stands as a testament to the power of deep research, bold thinking, and the courage to go against the tide. For all the young leaders, aspiring entrepreneurs, and business owners present today, this is a unique opportunity to gain from the clarity and conviction that drives Mr. Bhaiya's investment philosophy. His approach to identifying potential where others may not look, his emphasis on long-term value creation, and his leadership in building Equitas from the ground up offer powerful lesson in both business and mindset. Whether you're running a startup, selling a business, or navigating your career, today's session promises valuable insights on risk-taking, strategic foresight, and the importance of staying true to your vision even in uncertain times. Guys, without any further delay, please join me in giving a warm welcome to Mr. Siddharth Bhaiya.
I think your PLS has given 100% returns compared.
Guys, can we have a huge round of applause again? We have amongst us the brightest in the business, Siddharth Bhaiya.
Hello everyone. Good evening.
Hi Siddharth Bhaiya, welcome again to YLF. It's an absolute honor, literally an honor to have you here.
Thank you. Thanks a lot. I've come to Calcutta after a long time. So, it's a pleasure coming to the city.
So we've all followed your bold calls, in the market and the contrary picks. But today we'll do something different. Today we want to go behind the scene, behind the CNBC interviews, behind the numbers, the market. We want to know about Siddharth Bhaiya. We want to know how you started Equitas. What was it? Your vision and itch?
Okay, so I think it goes much more beyond, or I'd rather go a lot more behind. Okay, I grew up in a suburb around Mumbai, and typically used to take the local train to reach your office, and one-way commute was 1.5 hours. And luckily, I say luckily for me, my parents didn't own any real estate in Mumbai, and I said, I was pursuing my CA, and I said, if I want to succeed, I don't have an option but to make money. So I said, well, what's the best way to make money? The best way to make money is get into the stock markets. And luckily for me, I read a lot of Warren Buffett, Peter Lynch. I read a lot of books on value investing, and that really helped me in my journey as far as the stock market is concerned. So yeah, it started off with that, right? And then in 2012, 13, I kind of decided, I was unhappy with the manner in which the industry operated. And I said, let's do something different, let's do something very unique. Let us focus on creating wealth for clients. And that's how the journey began. And we've always focused on the clients. See, everybody talks this language. We want to focus on our customers and our clients. But at the end of the day, the proof of the pudding is in the eating. And when we say that we have delivered 33% CAGR returns for our clients, that means that we have worked for our clients. Right, Sagar? So what we say is, we're not the most intelligent out there. There are fund managers who are probably far more intelligent than us. But I can promise you one thing, nobody will beat us on ethics.
So let's zoom out. How do you see the Indian equity space develop over the next 5 to 10 years, and which sectors do you think will be the largest wealth creators?
So, okay, let me go back to what's happened in the last 10 years rather than, first to get an understanding of what's going to happen in the next 10 years. It's very difficult to predict. Who would have predicted 10 years back that, Zomato would be such a big company, or for that matter, demand would disrupt the industry and then itself get disrupted within 2 years. So very, very difficult to predict what is going to happen in the next 10 years. But let's go back and see what's happened in the last 10 years. Right? In the last 10 years, the small cap index, has delivered 11-12% returns. The Nifty has delivered around similar 9-10% returns. And will that continue for the longer period of time? Yes, it will. Okay, but a lot of these returns have been back-ended. In 2020, believe me, the small cap index was down 33% from its peak in 2008. So over a 13-year period, the small cap index had actually delivered negative returns. How many of you were heavily invested in small caps in March 2020 back then? Right. And the one question I want, so if you were, then you would remember how bad the markets were at that point. And since then, it's been a one-way ride. So for me, valuations matter a lot. Okay, last 10 years, we have seen post-global financial crisis, perpetually low interest rates, and a lot of money printing. And what's happened is, in that period, basically asset prices have gone up. Government has been telling you that there's no inflation, but there's been inflation. See, if so much money has been printed, it has to go somewhere. Right? It didn't go into oil, it didn't go into wages, it didn't go into anything. It went to asset prices, and asset prices kept on going up. And the worst part is people in the financial services industry started thinking that they're all geniuses. Correct? Basically, PE multiples have expanded. I've bought stocks at 3-4 PE multiples. And today we are talking about companies at 10 times revenues and whatnot. So, next 8-10 years is again like last 200-300 years. Is going to reward the person who's going to invest sensibly, who's going to focus on the 3 most important words, which is not made in China, not it is I love you, but it is margin of safety, as far as investing is concerned. So as long as you focus on margin of safety, you will always come out on top in the long run. I'm not saying in the short run, but in the long run, as long as you focus on margin of safety, you will do it. Whether it is commercial real estate, whether it is equities, whether it is bonds, at the end of the day, if you provide yourself with enough margin of safety, your long-term returns are going to be good.
I have a fun question for you. If you were the next finance minister, what would you do different?
What would I do differently? I would, make taxation arbitrage that is there right now, which is driving a lot of people towards equities. I would, today we recently put out a note saying, people are saying nobody is doing fixed income these days. Everybody's asset allocation is heavily towards equities. And what people are saying is fixed income में मिल क्या रहा है? Post tax I'm probably getting 3.8, 3.7%. That's your actual return. If you do a fixed deposit, post tax, you're only going to get below 4%. But when you are investing in equities at 50p multiple, your implied return is only 2%, which most people don't understand. The whole concept of finance is lost on people. I asked all my young analysts in the team, how do you measure returns? And they said, अगर stock 100 का 200 हो गया तो 100% return. I said that is an outcome. That is not how you measure returns. You measure returns on the yield that you get on the investments that you do. People have forgotten that you buy stocks for the earnings, for the dividend. Everybody is buying, whether it is the startup space or whether it is the listed space. We are all playing the greater fool theory. We are not going and asking, I have bought this at X valuation, will I get it at more than X plus 1 valuation? We are not, today there are only 2 types of people in India. One is people who want to invest, and second is people who want to raise money. Nobody wants to do business. And everybody wants to start a company with the objective of valuation, not with the objective of value creation. You getting me? Means, so I think so that's what I would say.
Hi Siddharth. Many investors chase the perfect balance sheet, but seasoned professionals like you know there's more to the story. So we all here want to know, how do you build conviction in a stock, especially when it's under researched or currently out of favor with the market?
I'll tell you what, as a seasoned investor, I'll tell you, Shakira said hips don't lie. I'd say balance sheet doesn't lie. Okay, so for me, a strong balance sheet is the most important fundamental. aspect of a business. How many of you are businessmen out here? A lot of you, correct? And how many of your earnings got disrupted during COVID? Everyone's. What saved you at that point in time? Your balance sheet. It is your balance sheet that distinguishes an Indigo from a Jet Airways or a Kingfisher Airlines. Today, Indigo is where it is because all its competitors failed because their balance sheets were weak. So, look, guys, you're all into startup investing, and you have founders and promoters coming in, pitching sexy products and sexier businesses at even sexier valuations. But all I will tell you is the fundamentals of investing doesn't change. Business is about taking risk. Right? What is the idea of a business? The idea of a business is, I put in, or how, let's forget the last 10 years. Okay? Last 10, 12 years does not define business because business has been around. When the first voyage for Columbus was sponsored, it was a business venture. People pooled capital and they sponsored the voyage. So business has been around for far more. In business, you put your own capital with the hope that you earn some profit out of it, and then that will help you meet some expenses, and then you pour that capital back into the business to grow the business. That's how business is traditionally being done. Today it's a different style. We look at the successful companies, we look at the Amazon, the Googles, and a few of the survivors and say that's startup investing. At the end of the day, it is what you do with your capital, what kind of profits you make. A lot of old philosophies as far as investing is concerned will hold true today and going forward as well.
Do you want to learn more about what's the process for your investment, like from idea generation to actually investing?
So what we do is, we don't, at Equitas, we never focus on the narratives. You listen to a promoter, and I've met more than 1,000 promoters. Okay, and I promise you, not one of them has told me that my company is bad. If I would have listened to them, I would have definitely lost a lot of money. So it's come to a stage where I don't meet the promoters anymore because I know they've all died. Okay, so one of our philosophies at Equitas is do as the promoters do. March 2020, every single company in our portfolio, either the promoters were buying back their shares or they were doing creeping acquisitions. Is anyone a member of EO out here? You are. Were you there? I did a call in 2021 with EO Calcutta. Okay. So, at that time, Balrampur was at 4 times earnings, and CESC was at 2.5 times earnings, something like that. And everybody in the EO chapter in 2021, they wanted to discuss Asian Paints and Titan and HDFC Bank. They were people from senior management of Balrampur and CESC. They themselves did not believe in that stock. What has happened since then? Asian Paints and this have delivered negative returns, and Balrampur and CESC have become multi-baggers. So the concept of margin of safety remains very, very important. We don't listen to the promoters. We buy good companies, but we buy good companies when they're out of favor. Okay, that's so important. And we focus on the numbers. So tomorrow, whenever you guys are going for the Shark Tank thing, go ahead, do it, enjoy the experience. But when you invest, tell them, give me your P&L, give me your balance sheet. Throw away their forecasts. You want to know my forecast? In 15 years time, I'm going to be as big as Berkshire Hathaway. I'm willing to raise money. Tell me, who doesn't want money, right? Who doesn't want money? Don't get straight away, it's your hard-earned money, how you're going to invest. You are going to invest in a very cold and calculated manner, not on the basis of emotions. Thank you.
So you mentioned about value investing. So value investing has long been a cornerstone of fundamental investing. So what role does it play in your strategy today? And how do you navigate the balance between value and growth in in the current market?
Yeah, so I'll tell you, okay, value investing is never going to go out of favor. 1999 I saw tech stocks being talked about growth. 2007 it was real estate, infra, whatever. Today it is so much about the new age businesses and everything. And people think, wow, disruption. But disruption has been happening ever since we came down from the trees. That is our ancestors. We've been disrupting. If there was no disruption, there would be no microphone. There would be no LED screens. We tend to overestimate the kind of innovation that we have done. Okay. People said demand is disrupting, Amazon disrupted the Kirana guy, demand disrupted Amazon, Zepto's disrupting demand. But that's what humanity is all about. It is about innovation, it is about so value investing will remain at its core, it will not go away. You want to make money, you have to focus on value investing. When you buy a commercial real estate, what is the first thing that you would look for? You would look for what is the yield that I am getting on that. Right? When you are doing a fixed deposit, what are you looking at? The ब्याज कितना मिल रहा है? किसी को पैसा दे रहे हो? What is the risk that I am getting? Why in equities people are not focusing on the earnings yield? Why are people only focusing on the valuation and क्या हो सकता है आगे चल के valuation? If I am paying 100 rupees for an asset, and if I am getting 10 rupees on that, that means I am getting a 10% yield. After that, future nobody knows. If somebody is coming and telling you that this is what the future is going to be, they have no clue. Because Walmart was once the biggest company in the world, and then Amazon came and disrupted and killed it.
You invest a lot in small and mid cap stocks. So corporate governance is a very tricky but critical factor, especially in an emerging country like in India, where everything is not transparent. So how do you assess this corporate governance risk?
I think that's a very, very good question. And I'll answer it slightly differently. When things go bad in the listed space, at least you have an exit. When things go bad in the unlisted space, there is no exit. And I'll give you how bad can things get. Between 1991 and 1995, there were nearly 5,000 plus IPOs in India. Only during those 4 years. Do you know how many companies are listed in India right now on NSE? 4,500. After that, a lot of IPOs have come. So the survivorship bias comes in. All the companies that have got delisted, people have forgotten. Nobody knows that the LML IPO, LML was the two-wheeler company, the Ola of yesteryears, that IPO got subscribed 400 times. The company doesn't exist. So, lot of promoters, today promoters are selling left, right and center. Every day promoters are selling 10,000 crores worth of stocks. And mutual funds have become a conduit for transfer of wealth from the middle class to the rich. Companies which have not made 10,000 crores of profit till now are raising 10,000 crores by selling shares. और आप तो कलकत्ता वाले हो, आपको मालूम है प्रोमोटर के लिए कॉस्ट ऑफ इक्विटी जीरो. Right? So corporate governance is a very, very serious issue as far as India is concerned, and that is where you need lower PE multiples to justify taking that risk. I'm a chartered accountant, and as a chartered accountant, we were told that as an equity investor, you're the last, in case of a liquidation, you're the last in line to receive capital. पहले गवर्नमेंट आता है, फिर इनकम टैक्स डिपार्टमेंट आता है, सब लोग आ जाते हैं, क्रेडिटर्स है वो, अगर कुछ हो गया तो तुम्हारे पास नंबर आता है. So ideally equity is the riskiest asset class, and if it is the riskiest asset class, then you would want the highest return, and if you want the highest return, then you want the lowest P multiple. Getting me? See, if you're a businessman, okay, and your stock is at 100 rupees, and your earning is 25 rupees, okay, then your cost of capital is 25 rupees. 25%. But if your earnings is 10 rupees and if your stock is at 1000 rupees, then your cost of capital is only 1%. But then what is cost for you is return for me. So when I am buying stock at 100 rupees with a 25% return, I am getting, 25% yield. In 4 years, my stock is going to be free. But if you're buying it at 100 with a 1 rupee yield, earning, it will take you 100 years to get your capital back. Okay, growth, this is growth. Show me which company in the last, there have been a handful of companies which have grown at 30% for the last 5 years, which has been one of the best. I think that number is hardly 30 or odd, which is there in our latest newsletter. So if only 30 odd companies in India have grown at 30% for the last 5 years, how can you justify paying very high P multiples?
You've had a fantastic track record for over a decade now. But I think we all have that one stock in our portfolio that feels like a bad breakup to all of us. Like Sakai Dukti Navzar. What is that one stock that you wish you could go back in time and swipe left on? And what did you learn from that investment?
So honestly, it's not about stocks, right? One, because I don't get emotional about stocks. Okay. So there's not been a single bad egg which I can say has disrupted a performance. But what I can say is there's been COVID. Okay. In 2017, we became very nervous of valuation in small and mid cap space. And I publicly called it out on Twitter and said small and mid caps looks expensive. And we actually moved to 30% cash. But then I looked at my portfolio and my stocks and I thought, wow, valuation was still attractive. I don't need to go on more cash than that. And then the economy went for a toss for various reasons. And then COVID came and stocks fell like 9 pence. And we had actually just deployed before COVID. So COVID, COVID told you that anything can happen in life and in stock markets. I've seen oil go to 150 and I've seen oil go to minus $20. Right? आपको तेल भी दे रहे और आपको पैसा भी दे रहे. So, and I've seen, stocks go down below cash levels and much below cash levels. So, yes, that was a big, and as I said, extremes are possible in the stock markets. Luckily for us, we were not leveraged, we had known this. Our balance sheet was strong, right? So, we did not cut any salaries at that point in time. We paid everyone in our office, even then. So, yeah, it was a tough time as an entrepreneur, but a strong balance sheet helped. And the learning was there that in the stock market, you're only one big mistake away from blowing it all up.
Thank you. Good evening, Siddharth.
Hi.
Hi. In one of your interviews, you mentioned how important it was for you to be sitting on cash in your portfolio. Can you please walk us through what were the early signals that made you cautious and what made you take that call?
Okay, so when I started in 2013, and I got that question asked today after a very long period of time. We have a 210 this and there's a 10% carry. So look, everyone used to ask, "Take a 10% profit share to le loss hoga to kya?" Nowadays nobody asks about that. Right, but again, as I said, the valuations were terribly expensive. Our stocks, right, and these were stocks which our clients came back and said, "Kachra company." There was so much pressure of this, like there was a company called as Helicon Engineering. I bought it at, please don't buy it, it is terribly expensive now. If it is a good buy, I will never tell in a public forum. And be careful of anyone who's ever giving you stock tips. They probably want to offload it off to you. So I bought it at 60 rupees. The stock had corrected from 260, 270 all the way down to 60. 260, 270 was in 2008. So over a 14-year period, stock was down 70%. I had visited the plant, one of the best plants that I've ever seen. In COVID, the stock went down to 29 rupees. All my clients are calling me and saying, "What crap company?" And not just that, the entire portfolio according to them was crap. Okay, and then the economy started turning around, the stock started doing well. From 30 rupees, the stock went to 1500 rupees. And at 1500 rupees, everybody says, "Wow, what a great company." wow, everybody knows about APAR, everybody knows about Helicon, today, so during that period, the company also executed gears for the INS Vikrant, which we didn't know at that point in time. We knew they had done a 500 crore gear project for the Indian Navy, but it was not disclosed and nobody was interested. अब वॉर हो गया तो लोगों ने बोला और 4 INS विक्रांत बनेंगे, तो मार्केट कैप वापस बढ़ा दिया. So the telltale signs were all there. Promoters was raising money left, right, and center. As I told you, Helicon promoters, APAR promoters, Sanghvi movers, Jindal Saw, Jindal Singh, with all these portfolio holdings for us, the promoters were buying stocks in 2020. They are all looking at doing QIPs in 2025. Tell me, you are a promoter, you guys all run businesses. Would you ever sell your stock cheap? No. You will only sell if you get a good valuation. 100%. 100%, right? Now, if I do a business transaction or a stock transaction with you, who will know more about the business better, you or me?
Me.
Right? So, so that is why I say we do as the promoters do. When the promoters are buying back their stocks, we will buy. When the promoters are selling, we will sell. Do you know Tata Group in Chandra? What all Tata Group shares in 2020? From Tata Motors to Tata Steel to everything. Now, what better signal do you need? And then 2024, they said first IPO from the house of Tatas. Tata Technologies, the stock is down 50% from the listing price. And everybody says, wow, Tata ka IPO aa raha hai, as if Tata ki gaadi free mein milne wali.
So today we're looking at an index PE of 22 to 25 in Nifty 50 to Nifty 500. But the median PE is actually for Nifty 50 is around 30 and for Nifty 500 is around 42. So what do you make of this? Like, do you still have faith in the Indian market in this current scenario, or do you think this is more like a cautionary zone?
So what we did is forget everything. We looked at the overall Indian market cap. We divided it by the overall profitability. What we got was 33 times earnings. So that is the PE multiple for the country as a whole. 33 times earnings. At that level, you are getting a 3% yield on your portfolio. Trust me, by any stretch of imagination, it is terribly expensive. Don't let anyone fool you that this is a growth country, but this is also a country with a lot of corporate governance issues. I can tell you at least 20 nifty companies which no longer exist. Yes Bank, so it exists, but for whatever reasons, the stock has got notice. I'm talking about India Whole Housing Finance, so many of these companies, an IndusInd Bank, which is a nifty company, you had fraud being discovered in a nifty company. So why would you pay very high PE multiples where you're not in control of what is actually happening behind this? So for me, it is definitely valuations are very high. Correct? In 2020, you could throw dots, pick stocks. You could create 5 portfolios, 10 portfolios. How many stocks have gone up 50x, 100x since 2020? At least 2,000, 2,500 stocks. All you have to do is buy stocks and hold on to them. But तब आप लोग ले रहे थे Asian Paints, Bajaj Finance, HDFC Bank. कभी कोई mid cap, small cap नहीं लेता था. Correct? So, but right now, maybe you could have 5, 10, 15 stocks which might do well from these levels. I play the probabilities. The probability of me making money at these levels is very, very low. That is the reason why we are sitting on cash.
You've said this once. When your boot polish wala tells you that stock lena chahiye, that's where you hold your ground. You take that caution. So even when the markets rise, how to not get tempted. We see that people get carried away, like you did mention. What is a better trigger?
The biggest problem for all men to lose money is parties. You go to parties and after a few drinks, nobody ever lost money with stock markets. Particularly if there's a good-looking woman around, they all like to boast about how well they've done. and they all own the stock, which is done, best over the last 2 years. And guess what? They just bought it 2 years back, right? You get a lot of that, right? You can blame your looks for that. So, that's how it is. So, all I tell people is, if you don't have a published return, if you don't have an audited return, I don't believe in you. So, listen, FOMO is what drives people into stock markets. People will come and tell you, yeah, this stock में इतना पैसा बना दिया. Trust me, it is going to drive you crazy. You will not sleep well. So be rational in your, as I said, cold, calculated, and think rationally. Maybe consult your wives; they will do better decision. No, honestly, I personally feel men are driven by testosterone, women are driven more by logical thinking. That's why gold is doing well.
Speaking of gold, he has a few gold questions.
So I'll start with, since India is so expensive, are you allocating capital to other international markets?
Yes, we've invested in Far East. You'll be surprised at the valuations that you get in international markets. Hyundai in Korea was quoting at 4 times P multiple. Hyundai India did an IPO at 37 times earnings. And before doing the IPO, they took all the money and dividend back to Korea. Mercedes-Benz is quoting at 5 times. BMW is at 4 times. A few months back, I think Prithpal pointed it out. That ThyssenKrupp in Germany had $1 billion of cash and $1 billion of market cap. Correct? People talk about banks being cheap in India in terms of valuations. Kotak, ICICI, HDFC, Axis, all probably quoted closer to 3 times price to book. A few percentage points here and there. Some of the biggest banks in the world, from JP Morgan to HSBC to Barclays to BNP Paribas, they're all quoting at 0.6 to 0.8 times price to book. The difference between 0.6 and 0.8 is an 80% discount. Okay? And if somebody is telling me that HDFC Bank can grow at 30% from these levels, it's not possible. Because once you're the 4 largest banks in the country, your deposit growth cannot outgrow the growth rate of the industry, which is deposits are only going at 10%, thanks to everybody wanting to come into the stock markets. So internationally, valuations look, companies like Meta and Apple and Microsoft, have started looking cheap to me because they're at 20-25 times earnings. At least I spend a lot of, me and my kids, we spend a lot of our money, spending time on these apps. So,
We live in really exciting times. There's wars, trade wars. How do you factor in macro risk?
Why, you guys are in Calcutta, right? Far away from the bombs. So it's exciting. Once your bombs exploding right next to you, it is not exciting. But look at it, this is tough times. With trade wars, you don't know. A lot of your businessmen probably have exports. You don't know what is going to happen. People are underestimating the impact of trade war. Second, with wars, it's escalating at a very rapid pace. It's Russia, Ukraine, it's Israel, Iran. I heard that North Korea has fired some rockets today. So we need to be careful. Oil is already at $78 as I speak. Okay, so and we are our rupee is very susceptible to any rise in oil prices. Look, and as I said, we've been studying China. One of the reasons oil prices have not done well in the last 3 to 4 years is because China has done a lot of electrification of EVs. EVs today comprise 60% of all sales that happen in China. Nearly 45% of the total fleet in China is already CVs. In India, we're not even selling 4 to 5% of our incremental cars as EVs. So because one of the biggest consumers was out of the oil markets, oil prices did not go up. Now, because of geopolitical issues, if oil prices go up, it leaves us very vulnerable.
And let's talk about gold. It's had an exceptional run-up, and And do you think it's going to still do well from here, or maybe silver is something we should look at?
See, I'll tell you one thing, my wife is very happy with the gold investments. But no, besides that, I think I'd done a presentation on gold in 2021 at IIC Goa, where I had talked about why gold should form part of your portfolio. Okay, there are multiple reasons why gold. Do you know how did the fiat currency come into play? The Bank of England 200 years back said, why do you bother carrying gold with you? Do one thing, we'll give you paper currency. And any point in time you want the gold back, we'll give you that gold and you can return that currency. So at that point in time, 10 grams of gold was equal to 1 pound. And then people forgot that, and then the debasement of currency happened, kept on happening. So one, gold is a great store of value. You have to understand, an ounce of gold is an ounce of gold anywhere in the world. If you are in Ukraine or if you are in Syria and you need to cross the border, the only thing that is going to save you is your gold. Because you can trade that gold and at least buy some food. So gold is a great store of value. All the gold that is there in the world, okay, can be stored in a 30 by 30 by 30 square feet cube building. So it is very easy to store gold. Gold doesn't decay, it doesn't have an half-life. So million years down the line, a kg of gold will remain a kg of gold. Gold is extremely malleable. If you draw 1 mm thin line, I told you, probably 3 times the size of this ball, we can store all the gold in the world. Right? Just 3 times this, 30 by 30 by 30 square meter cube building. All the gold, which is 24-25 trillion. But it is so malleable that if we draw a string, which is 0.1 mm, we can circumnavigate the earth 11 million times. So it lends itself perfectly for making jewelry. Right? And 50% of the world's population wears jewelry across cultures, from Australia to the Middle East to India, Asia. So, to me, central bankers will never buy bitcoins because it's too volatile, but they will always buy gold. It's been around for billions of years, it will continue. All the gold that is there in the world is finite. Whatever gold was there when the earth was originally formed, because gold is one of the heaviest metals, it went to the core of the earth. So what we have on the surface is what came through meteorite shower. So next time we want to have more gold, we'll probably need a big meteorite to strike us, at which point in time we will not survive. So that time gold or equities, nothing will matter. So gold, according to me, should be part of your asset from a long-term perspective. At this price, I don't know, I bought it at much lower prices, so I don't want to recommend, and I usually don't make recommendations. All I can do is I can give you the facts. We have 3 excellent articles on gold which are written on our website. I would recommend that you go through it and then take a old calculated decision of buying gold.
So there's been a lot of buzz around the valuation, except the PE for most of the stocks are high. But what about the PEG ratio? PEG ratio is PE versus divided by the growth of the company. So especially in small and mid cap companies, where you said, हो सकता है आज 10 रुपया कमाने वाला कंपनी 1000 में मिल रहा है, but given the capex or the growth story of that company, next year 10 रुपये का सीधा 100 रुपया होने वाला है. तो आज 1000 में मिल रहा है, so that comes straight away comes to 10 P or whatever.
So again, it's a PEG ratio usually comes when the market is a little higher. But besides that, jokes apart, look, you're a businessman. How difficult is it to grow your business? Do you think you can grow your business at 30% for the next 10 years without any challenges? Possible. Then what makes you think that the company that you're in, here you are in control. Here you can sit and work 18 hours a day. If you want, you can this. There you're not in control. आपको नहीं मालूम कि आपका फाउंडर वो जाके गोल्फ खेलता है या रात को 12 बजे तक काम करता है. So it's a way of trying to justify higher valuations. Sure, I'm telling you, peg ratio, I'm telling you, there are not more than 30, 35 companies which have grown at more than 30% for the last 5 years. That is how difficult it is to run and grow a business. Right? Look at me, I'm the best performing over the last 12, 13 years. I should be now, and I started much before everyone else did. So shouldn't I be the number one? I'm not, in terms of AUM, for various reasons. So it is not that easy. If I have to grow, I have to sacrifice on my profitability. So it's not easy. The peg ratios, let's not get into any of these, keep it simple. Investing should be a simple ये. मैं अगर 100 रुपया दे रहा हूँ ये चीज़ का तो मुझे कितना मिलेगा? अगर मुझे प्यास लगी है और मैं 60,000 रुपये को मैं इसको 5,000 रुपये भी दूंगा, नहीं तो मैं इसका MRP के ऊपर 1 रुपया नहीं दूंगा. Correct? That's what investing is about. Right? When I buy this, I look at it. Should I drink this water? Should I pay 20 rupees for this? Maybe yes, because otherwise my gut will not be able to handle the other water. That is why. So you have to do a very cold, calculated decision while making investment. Forget the peg ratio. You don't know what is going to happen next quarter. Can you tell me within 2% range what is going to be your profitability for the next year?
Not to the point.
Even with the 10% variance, can you guarantee me? Not really, right? So then what makes you think that for some other business about which you have no understanding? You run your businesses, how many variables do you encounter? N number of variables, which you are not able to forecast in your own business. And you think you can forecast the variables for the business which you don't want? So
with AI, algo trading, and tech-driven platforms changing the way market operates, how do you think the role of a fund manager is evolving in the current market?
I think it's a lot of things don't necessarily change. Whether it's investing, whether it is your health, whether it is what you eat, a lot of these things, for me personally, whether it is when the calculator came or whether the computer came or today whether it is AI, it is a tool for you to enhance your business, to enhance your thought process. But it does not fundamentally change the underlying thing. The first question that I go and ask every single company that I invest in is, what are you doing with robotics? How are you using AI? Right? We've been using AI a lot in our business for the last 1 year. Because if you're not going to use AI, then you're going to be dead. If you're an employee, you're going to be dead. If you're a company, you're going to be dead. It is going to be disruptive. Imagine करो जब first time calculator आया, जो मुनीम बोला कि नहीं मैं तो हाथ से ही कैलकुलेट करूँगा, वो कंपनी और वो मुनीम दोनों आउट ऑफ ये चले गए. Because the calculator came. When the computer came, there was so much. The opposition party at that point in time actually came and said, कि railway should not adopt computerization because people will lose jobs. That is what was actually, there was a strike and everything around railways saying no computerization because people thought they would lose their jobs. But what did computerization do? It actually increased jobs. So these are tools which will help us, and that's nature, right? Today it is AI, tomorrow it will be something else. We will have to keep on adapting, otherwise we'll all be dead. Right? If Walmart did not adapt, Amazon came and disrupted it.
How do you distinguish luck from skill in investing?
That's an excellent question. That, trust me, is one of the most important questions that at every single point in time, I keep on asking. That how much of the returns is due to skill and how much of the returns are due to luck? Okay? The skill is the process. I'll give you an example here, right? We made a lot of money for our clients in HEG and graphite both. And we bought HEG in 2012-13 when we started. The stock price was around 250. And the process was right, the valuation parameters, everything was right, the valuation was good. Everything went off well. 2016, the company reported record losses, 150 crore loss. And the stock was down to 150 rupees. Okay. Now at that point in time, if I look at the stock price and say my skills are bad, but I said no, my skills are not right. The parameters that I set in were right. Guess what? After 150 crore loss, that means everybody in the industry was making loss. One of the biggest companies in the world, Kraftech, went belly up. All of a sudden, there was shortage of graphite electrodes. Prices of graphite electrodes went from $3,000 to $15,000. And stock of HEG in 1 year went from 150 rupees to 3,500 rupees. We made truckloads of money. Now there were two elements involved in us. One was the skill. The skill was in identifying the company. The skill was in holding on to the company through tough times. Right? At that point in time in 2016, we were up like 50% for 3.5 years. But client फोन करके एक ही चीज पूछता था, ये चीज ही नहीं चला, तो आधा % रह गया portfolio का. But that's what it is, and a lot of people would have sold it off, but we did not. So that was the skill. The luck was that graphite electrode prices went to $15,000, which, trust me, neither the promoters knew, neither nobody in the industry knew. So there was an element of luck, there was an element of skill. Correct? My best winners have involved elements of both. Right? Luck is that I was born in India, not in Pakistan. Right? A great country to be born in. Luck is that I managed to enter stock markets. I might not have got a job in 2001 and I would have given up and could have happened, right? You know, it's destiny. Skill is that I worked hard for the last 25 years and stuck to my guns.
Siddharth, the market is often euphoric before it crashes. From your experience, how do you identify when a booming sector is close to its peak? Are there any specific signals or red flags that you watch out for?
A booming market tells you in the face. Okay, look at defense stocks at this point in time. Okay, they're all quoting at 60, 70 P multiple. Means you'll actually have to do another war to justify those valuations. And then people are talking कि defense spending तो यही होगा. Means हम 50 साल से मिसाइल बना रहे एक ही बार यूज किया. And I hope we don't have to use it again. This is not like toothpaste where you keep on using it every single class. Correct? Now, if people are talking about this budget spending, that defense spending, now if the government were actually to go and spend that much on defense, trust me that money will have to come from other places. Maybe your roads will not get built up or your railways will not get built up. Because you cannot, the money is finite, right? Even if it is. So a lot of times, it stares you in the face that if I'm going to buy these stocks at 60 PE or 70 PE or whatever, am I going to make money in the long run? Am I getting the yield that I'm desiring? This same HAL जब IPO आया था, तो there was a big article that HAL doesn't have money to pay its salaries. Stock actually corrected 66% from the IPO price. What was right about it was then the valuation. What is wrong about it is the valuation. The company is the same. Nothing justifies a business value going up 35-40x in 4 years. Unless you do something like an Nvidia. But I don't think so. Any of the Indian companies are truly innovators. And so a lot of times it stares you in the face, but somehow we get carried away with after a couple of drinks. And the stories that we hear कि वो HL का जब आया था ना, मैंने shares खरीद लिए थे.
So, what's your view on investing in startups versus public equities? Do you think both can coexist in a well-rounded portfolio?
So the only startup I've invested is in Equitas and my wife's venture. My wife has taken the money, not given me any shares. But how do I put it this way? Like you guys, we have an event coming up tomorrow, and all I can tell you guys is be sensible. Be sensible. I don't want Sagar, otherwise ensure I don't leave Calcutta. So be sensible. Investing is about being sensible. Look, I'll give you an example. When we were kids, we used to play cricket 12 hours a day. Okay? And today, I see that within our complex, they have an evoked Premier League. क्रिकेट तो होता ही है, साथ में ऑक्शन भी होता है, एलईडी लाइट्स भी होते हैं, except for I think those dancers, everything else is there. Right? Thankfully, the elders and this have not permitted those things. But so to me, that's woke. Rather than playing cricket, everybody's got those jerseys, the sponsorships, that everything. So खेलो ना, खेलना है खेलो, मैचेस हम भी खेलते थे, the trophy used to be जो जीता उसका tennis ball. Right? So even with investing, like don't get carried away with all the glam and any of those things. जाओ मिलो, enjoy करो, invest, have fun, enjoy the glamour, but be very very sensible when you invest.
Thank you. So now we come to
that's as diplomatic as I can get.
Okay, we come to the funner section of the evening. We call it the Bhaiya Blitz.
Okay.
This is an unfiltered rapid fire session, and we're going to just be shooting questions, limited words as answers. PMS versus mutual funds. Which one actually delivers value and which one is overhyped?
Mutual funds. ETFs.
What's one myth about fund managers you'd love to bust?
Myth about fund managers.
That they know everything about the markets.
If a Gen Z came up to you and said, I want to invest in crypto, what would you tell him?
I tell him I've been wrong, maybe you'll also be wrong.
What's one stock you wish you had bought way earlier? I hope it's not MRF.
I actually own Wipro since 1976. I'm lying. I'm not drunk, but I can always still lie, right? No, see, so errors of omission don't matter. Errors of commission do. So I have no regrets about missing out on so many opportunities.
Do you secretly enjoy when the market crashes? It's like Black Friday shopping for you?
In my younger years, yes, because I had less capital. Today I don't because I manage public money and plus me they give you the hell when markets crash.
What's one sector you think people are irrationally obsessed with but you don't think is going to do well?
Stock markets.
First thing you did when you made your first big profit?
Invested more.
What's more scarier? Stock market crash or your wife's shopping bills?
Luckily for me, I have a very sensible wife, so she likes gold, I like gold. We are a happy couple.
If you had a Bollywood movie title name for your portfolio, what would it be?
Mission Impossible.
A book or a movie that changed the way you look at the world?
Warren Buffett. Movie, person, religion, everything. I think everyone is above 18, right? So I tell in my office that the only person who gives me orgasm these days is Warren Buffett.
Is financial advice from influencers on social media a new asset class or a disaster waiting to happen?
It's a disaster which has already happened. Right? So it's not something waiting to happen, it's a disaster which is waiting to happen. Right? You see so many people being fooled by these Instagram videos. So, yeah, are you referring to me?
My mom sent me reels, says you stop like her.
It was my mom was in the reel.
Who's the Amitabh Bachchan of the stock market today?
Who's the Amitabh Bachchan of the stock markets today? I think Radhakishan Damani.
One thing investors won't like to hear from you, but you know it's the truth.
They don't like to hear when I say the markets might go down. Right? I'm called as the pantomime villain of the country. They said you are bearish on the country. I said if I was bearish, I would not have made the kind of returns that I have made. So I'm very bullish on us as a country. We're all going to do well. I'll tell you, right, before we digress, I think the future of India lies not in the people who are sitting here. The future of India lies in the people who are working for you. Right? Your house helps, your drivers, your this. It is their kids who are going to become the next doctors, engineers of this country. I see that around me. So go ahead, encourage people to spend, educate them. Two things that you can do for people who work for you is educate them and take care of their medical needs. That is where the progress is. China is the biggest exporter of manufactured goods to the world. We are the biggest exporter of talent to the world. Right? So there's a lot of hope for India. We're going to do exceedingly well. I'm proud of our country. But as he said, your proudness does not necessarily mean that it will translate into stock market returns.
We'll take some questions on the
Yeah,
yes.
but before we do that, one last final question. One stock we should buy. I have a lot of people who are eyeing me for that question.
No, let me see. I don't have any stocks to sell. If I had stocks to sell, I would have told you buy. Because you guys would buy. No, again, honestly speaking, listen, never take tips from anyone. One of the reasons I am so successful is because I don't attend any stock market parties. People attend stock market parties just to get tips. And once you don't, do you think I can buy Helicon at 60, see a price of 29 if I don't have my own conviction? When every single client of mine is coming and telling me your portfolio is full of kachra stocks. Do you think I have the conviction to say I'm on 90% cash today based on my meetings with everyone or because of, so do not, investing is not that difficult. Take up a book of One Up on Wall Street, read Warren Buffett letters. Your health and your wealth, you have to train yourself. No doctor is ever going to tell you blood pressure है ठीक है, शक्कर कम करो, नमक कम करो, थोड़ा jogging कर लो, health ठीक हो जाएगा. He will give you telmisartan and whatever, because then you will come back to him after 1 month. कि डॉक्टर तब तक दवाई लेते हो तब तक ठीक है, उसके बाद में वापस बढ़ जाता है, तो और ले लो. So no, I've never given tips. I will never give tips, and I would strongly advise you not to take this because you will never have the connection. Every Rakesh Jhunjhunwala told everyone, night and radio. चाहे आप सुबह जाओ या शाम को जाओ. Whether he was sober or whether he was not, he always told you Titan. But none of his friends, even his closest friends, made the kind of money that he did because he had the conviction. So you have to build the conviction.
We'll ask a few questions from the audience.
That was a beautiful, wonderful session. We all, I'm sure, got a lot of valuable insights. Talking about Alcon Engineering, you could spot them at 29, but do you have any scanners or how do you spot such stock with low PE? Because like you rightly said, there are so many stocks, so many sectors. So how do you come down to those stocks, and if there are any scanners?
I think that's a very good question, and I would combine that with the previous question on, which stock. What I'll do is I'll give you a simple tool. Focus on buying stocks at less than 10 P multiple. Focus on buying companies with net cash on the balance sheet. Okay. Focus on buying industry leaders. Okay. Like larger companies. Don't look at the market cap. Look at companies which are say among the top 500 or 1,000 companies. So low P multiples, cash on the balance sheet, good dividend yield. Simple things. And today the best part is you have something like a screener. Then you probably pay 4,000 rupees per year and you get it. All you have to do is just spend some time. So many of the companies around here have been available at 3 and 4 P multiples. You would know their promoters, whether it was a Rampur Chini or whether it was a CESC or whether it was a Manthan Alloys or even Shah Metallics, and a lot of these companies were available at such cheap valuations. ITC, the whole of Calcutta smokes, man. 150 रुपए में आपने किसी ने नहीं दिया.
COVID time.
No, much after COVID. Till 2.5 years back, ITC was at 150 rupees. Right? When all the memes of ITC were floating on Twitter. So keep it simple. Look at some of the screeners, as they say. low P, high cash, dividend yield, 10-year history, yeah, industry leaders.
I have a more slightly technical question for you. So, say this is that you learn buying first, selling then, and then position sizing. So, do you have any hard and fast rule for your entry while you are entering a stock of position sizing? And if it grows, say 10x, and it becomes say 50-60% of your portfolio, do you trim it or you still keep it let it down?
First, buying is the easiest part, isn't it? Buying stocks is, पहले कोई phone करना आपको निकल जाता है. So buying is the easiest part. Then comes the lessons, right? If the stock goes up and we sell, and if it goes up even more, then we've learned a lesson. If we don't sell and it comes down below cost, we learn a lesson. So over a period of time, as we keep on learning, we learn lessons on how to sell, right? So for me, buying is the easier part. As I said, buying is the easier part. Selling is the more difficult part, because I have bought stocks at 100 rupees, see them go to 550 rupees, sold them at 500, and then seen it go to 5,000 rupees. Now those are lessons that you learn. So buying is easy, selling comes with experience. The third question, the bigger thing is position sizing. Position sizing comes when you have enough capital, and enough capital comes when you've learned how to buy properly and sell properly. Right. So I would say position sizing is, it's such an overrated thing. When I construct the portfolio, I buy 16 stocks, 6% each, and then I allow them to run. 6% stock can become 20% of the portfolio, and I would not trim it. Right? So what you need is keep it simple. Don't complicate. Investing is a very commonsensical, very simple thing. Buying right, selling. When you go to parties and everybody is talking about a particular stock, right? I'm sure all parties around here are now about defense and capital market stocks. Correct? Everybody is talking about BSE and CDSL and NSE, HAL and this, and nobody is talking about these stocks. So it's very simple. You will get the clues. If you get it right, you will get the clues.
So how do you react to speculations and market sentiments? Like for example, you said that China has already converted to EV many folds in comparison to India. But when we talk about EV in India, then a lot of people say that EV is actually going to get diluted when hydrogen fuel comes in. So how do you react to such speculations, or maybe something like there could be a third world war and the markets could drop drastically. So how do you react to these?
I think if there's going to be a third world war, then I'll be worried about not the markets my life. Right? But look, as he said, hydrogen works well when you're trying to peddle a story. What I want to see is, are there EV cars which are actually selling? When we bought BYD, when we did our first presentation, BYD was selling 1.8 million vehicles. Just like 2 years back. Not even 2 years, 18 months back. Now we are updating our presentation and it is saying BYD is going to sell 5 million cars this year. From 1.8 to 5 million in 3 years. Now that's reality. When we bought, BYD was at 11-12 times earnings. And BYD today is going to sell more cars in the entire auto industry combined. Now these are facts. This is actually happening. I wouldn't want to believe on the stories or whatever people are this cold, calculated, investing. If you start seeing hydrogen vehicles, you test drive one, you like one, maybe you should buy the vehicle and buy the stock as well.
Hi, good evening.
Hi.
You have a very regimented approach to the stocks you are buying. Has there ever been a moment where you had to break your own rules to buy something, and if that ever happened, what was the outcome?
You know what? Every time I've broken the rules, I've lost money. So it does happen. We're all humans at the end of the day. We have a checklist, which is a 17-18 point checklist internally, which we look at when we are buying. Does every single stock fit into that 17-18 point checklist? No, it does. Nothing, and there's nothing like a perfect investment. You always have to make compromises when you are buying. There's nothing, if it was a perfect investment, then there would be no risk involved in that. So, yes, we do. We make mistakes, we learn from them, and we note it down. Okay? So, I'll tell you one more thing, and this is very important. I told somebody today in one of our meetings that stock market teaches you a lesson, but it doesn't allow you to decide the tuition fees. It decides the tuition fees. So, you have to ensure that the tuition fees that you pay to the stock markets are low.
Any specific event where you broke the rule and it was a real face palm moment for you?
Oh yes, it was one of the wind companies which is very popularly listed and multiple IPOs and QIPs, and I bought that. It was at 16, 17 times earnings, which was way beyond my buying range at that point in time. But the growth was fantastic. Okay, let's not discuss names because multiple IPOs, QIPs, you get the hint.
It sure took the wind out of you.
And then promptly what we realized is, they were actually booking revenues on order booking, not on execution. And obviously we ended up losing, 70-80% on that stock. I read the annual report once again. I realized, there was nothing mentioned in the, I wasn't wrong, because there was nothing mentioned in the annual report to that extent. Right? The data were pretty high, but because it was a fast growing business, I thought, the data is high, ho sakte hain. So that was, you learn from it. But again, as I said, the tuition fee that we paid was small for that, because we did not lose a lot of money. And that's very important. That's where I keep on hyping and reiterating the point of margin of safety. Another stock where we lost a lot of money, we did not lose a lot of money, but lost a lot of reputation, was Talwar. It was listed, we bought it at 4p multiple, right? My bad, I relied on it to be an analyst. Look, bull markets, we all make mistakes. And there were a lot of issues, corporate governance issues, and we lost, in percentage terms, we probably lost 80-90% of that stock. But in overall AUM terms, we did not lose a lot, it was only 20 crores. But when you're a fund manager, you have to remember that if you lose money, the client starts doubting you. Doesn't matter how much money you make. As a fund manager, you're only as good as your last call. कल अगर मार्केट चल गया तो सब लोग बोलेंगे किसको बुलाया है सागर ने इधर और इधर गिर गया तो फिर I will be attending across the country. But yeah, so that's it. There have been mistakes. You make mistakes. You are a human, right? But to not commit the same mistake twice is probably a good fund manager.
Thanks.
Do you give any importance to free cash flow per share or free cash flow metrics when evaluating an investment?
So I think, how do you look at free cash flow? I'll ask you, how do you look at free cash flow?
I mean, the formula is very simple.
Forget the formula. Right? It's not the formula. The free cash flow comes on the balance sheet. The free cash flow reflects on the balance sheet. How much cash does the company has? Company like ITC will always have cash on the balance sheet, or Britannia or something. Now that is one part. Second is you could have a high growth company which could be investing very heavily for a 3, 4, 5 year period. But then after that, will it be able to generate a lot of free cash flow? So what I typically want is a lot of cash on the balance sheet. And I distinguish cash on the balance sheet from cash earned from operations and cash raised from Chanda, which is IPO. Right? A lot of cash which is raised from IPO, the promoter cycles it off over a period of years. I've seen that with a lot of Indian companies. Company जब real estate बेचती है तो आधा पैसा promoter के घर पे जाता है, आधा पैसा company में आता है. Right? You will be surprised to know that there are many companies, listed companies in India, where the land is owned by the promoter and the factory is constructed by the company. Now tell me, a company and a promoter are two different things. Would you ever, as an investor, build a factory on a land which is owned by somebody else? So that's corporate governance. Free cash flow will always show to you on the balance sheet, on the cash side. That is why I said buy companies with cash on the balance sheet. You're never going to lose money in the long run.
Then we'll be taking last few questions.
My question is, does technical analysis be a part of your analysis when you're identifying stock, or it's only based on fundamental analysis?
Look, technical analysis used to work 100 years back when there were no computers and you do technical charts. Today, technical analysis is the easiest to learn. 3 हफ्ते का course कर लो, everybody is a chartist. But it doesn't work. I'll be honest with you, with computers and with so much of computing power, everybody can afford a technical analysis. So there's a lot of calls, breakouts, this, that. Look, there are smart promoters out there. When I was a young analyst, I went to I heard a distant discussion between our dealer and our fund manager. The dealer went and told the fund manager, sir, ये stock है ना chart पे breakout जैसा लग रहा है. तो बोला उसने बोले काम कर 1 लाख शेयर ले breakout हो जाए. So be careful. See, if it's so easy that you can do a 3-week course and start buying stocks and making money, wow! Why would you want to run businesses?
Hi, Siddharth.
Hi.
In today's world, right now, as you said, you are sitting 90% on cash, and the interest rates are going down. So, and every asset class, you see it's a bubble right now. So, where do you intend to put the money for next 1 to 2 years?
I can't tell you where I intend to put, but I can tell you because my intentions can change tomorrow. My intentions can change tomorrow, and I can't. Look, if there is going to be a war or something drastic happens, I could just take my money and move probably, somewhere in the middle. No, I'm just joking. But tomorrow, markets could crash 20%. I could move to equities. So very difficult to say. What I can tell you is where I am right now. With 33% into gold, we are 33% into our Far East fund, and we're looking at deploying 33% into our international equities fund, which is going to be investing in developed markets and in high dividend yielding stocks.
Hello sir, my question is on cash levels. You have shared that you are on cash, and in terms of funding, there are very less opportunity. So my question is on all the mutual fund houses are on cash, and on global level there is a lot of liquidity. So at this point, how to manage those cash? Where to park those cash?
If you can give it to me, I'll take it. No, I'm just joking. But look, as I said, see, I can tell you what I'm doing. This is by no way a recommendation that you should go and sell your portfolio and sit on 90%. That's my appetite. I have, even if the market was to go up, it will not make any difference to me. You understand? Because I've made my money. We've made 51-52% CAGR over the last 5 years. The clients are not going to complain even if we miss out on some returns or any of those. Or even if they complain, I'm the one who's going to hear. So that's not an advice. All I can tell you is what I'm doing. Can I advise you on what to do with the cash? I really cannot, because I don't know your risk profile. I don't know what your earnings are. I don't know anything about you. So for me to give a blanket this, maybe you have to go to some of those influencers who आपको कुछ भी advice दे सकते हैं. But that's again, sit down, take a sensible call, read a lot of books on investing. Today everything is available. Read Warren Buffett, read Peter Lynch, and then you're young. You have a long journey to go. Invest sensibly. Hopefully you'll come out on top in the long run. No advice that I can give you as to what you can do with the cash. Instead, if it's surplus, I'm willing to take it.
Ladies and gentlemen, a huge round of applause for Siddharth. Before we finish, can we please have on stage Priyanka? She herself is from the Equitas team, and she has a short presentation for all of us. She's also helped us land Siddharth himself here. So again, a huge round for Priyanka who's here.
I'll get a girl, guys. I keep on rubbing her a little bit and saying, we bail you out of Calcutta. You ought to pay us some fees for coming to Bombay. She's absolutely in love with Calcutta too.
So guys, good evening. and I hope you all enjoyed the session. If that's a yes, I want a big round of applause once again. See, I've been living in Mumbai for more than 12 years now with my man, and it is the city of dreams, and I am living my dream. But trust me, whenever I'm back to this city, this is my city of joy. I love coming to this city every single time. And this time it was especially for all you dear friends, because when I walked into the room, I could see so many of you, who have been my juniors or seniors in college, or my school friends, dearest Ahuti and Ritik, when they reached out to me that, come on Priyanka, you gotta do it for YLF Girl. And then of course when I met Sagar and Natasha, thank you so much for being a wonderful audience. I just have one slide, not a very big presentation for all of you there. Can anyone guess what are these numbers, what are those names on that side? What can it be about?
Yes, these are all international PMS who manage public money and distribute their return and draw down here. And every year, make money.
No, Neeraj, no. Don't make it that complex. Let's make it easy. Can you see the fifth name up there on the slide? Yeah. One of the best fund managers across the globe. Yeah. So we have fund houses and the returns they've generated over the years. The third or the fourth column. The one that tops the chart is 30%. There's one fund house which has over 12 years delivered a CAGR return of more than 33% per annum net to its investors year on year. That's right. That's not good.
But I tell you one thing, never go by this. The difference between a 33% CAGR and a 17% CAGR doesn't matter how long your vintage is only a 50% drawdown in your portfolio, which I've seen multiple times in my 25 years. Okay? So thank you, Priyanka. You make a great list, but why not? Why did I say that? But because that is where you really respect Warren Buffett for the longevity. Okay, you might think 20%, ठीक है मैंने तो एक साल में कमा लिया 20%, मैं Warren Buffett. You have dime a dozen people who don't even have $1 million who are criticizing Warren Buffett, who's got nearly $1 trillion. So the difference, as I said, more importantly is capital preservation. To answer your question, what should I do with my cash? Is also preserve that cash. And the difference between, as I said, 33% and the 17%, 13 years of efforts could go waste in 1 year if you were to lose 50%. And that is where you have to really understand Warren Buffett. Look at the absolute 35.6491x. Our decimal is at 35.64. Correct? So that's the power of compounding. Don't lose money. Don't lose money. That's the important lesson from that.
What I was trying to, amplify your data only, that don't go by the narrative. Do cold calculated calls. You all missed out the most important and the biggest number up there when I put the slide up there, right? It was 356,491x. So do your cold calculated calls and enjoy the dinner. Thank you.
Thank you very much. And I'm really glad, we have a calculator girl on the team. She's really, really good, right? You just saw that. Never misses an opportunity.
Good evening, everyone. As we come to the close of day 1 of the YLF Business Conclave, I would like to express our heartfelt gratitude to our esteemed speaker, Mr. Siddharth Bhaiya, for his extremely sharp, direct, and very insightful session. Thank you, sir. We are also grateful to Mrs. Priyanka Damani Daga, whose efforts helped get Siddharth Bhaiya for this session. Can I now call upon Mr. Prateek Dugar, YLF committee member, to felicitate our esteemed speaker. Sir, can we have